Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to a special edition of Bloomberg Daybreak Weekend, our global look at the top stories in the coming week. From all of our Daybreak anchors, including Tom Busby. This is not Tom Busby. It's Tom Keene. McKee had a tantrum and said, I'm only going to talk to Tom Keene about next week. It's just so exciting. Michael McKee joins now, driving all of our economic work here. Of course, off a blowout 272,000 job statistic. Once again, it's morning in America, except for inflation. Inflation is out there. And to drive Daybreak forward into next week, am I right that we have an inflation report at 8:30 and a Fed report at 2 p.m.?
Yes, the Fed will be getting the inflation numbers just before they vote. However, they've probably done most of the math, and generally economists are pretty good at forecasting the price indexes. So there might be a surprise, but if there's no surprise, then not going to change anything in their outlook. They will have submitted their views on what they think is going to happen going forward, and we'll get the dot plot, and we'll see what they say.
Is this a 2-hour conversation? You and I could have it. I mean, there's so much going on.
Yeah.
My head's absolutely spinning about this from the jobs report, and we can look back at that. We'll touch on that in a moment. But let's stay on inflation now. I was making a joke with Claudia Sahm about the lift in cat food prices, which is tangible. Are we still seeing the shock in goods prices like Claudia Sahm saw with Puffy the cat?
Not the same way. Food prices, and I'm sorry her cat food went up, but food prices have been flat for the last couple of months. They haven't been rising, been one of the bright spots for inflation overall. Goods inflation has gone up a little bit in the last 2 months, but very little. It's still services price inflation that is rising, and that's been the Fed's worry because labor is such a big part of service price costs. And labor went up, and we saw an increase in average hourly earnings.
Well, let's span the globe as they used to do on Wide World of Sports. Claudia Sam's got the cat food up. I got vet bill and kennel fee, and let me tell you, I can tell you, service sector online is up. It's not up modest, Mike. These are real jumps. Let's talk about service sector inflation that we're going to see the same day as the Fed. It's still tangible, isn't it? It's not disinflation, right?
Well, it's disinflation, but it's not deflation, certainly. It's not flat. It's been going up at a slightly slower pace.
Give me a number.
But it's been rising about 0.4 a month, and the Fed wants to see that down around 0.2 or lower. The question is, how fast do they get there? How fast do we see this stuff squeeze out? Now, we had the big rise in average hourly earnings last month, and some of that may have been the rise in California's minimum wage, which mostly affects service industry workers. So you have that service industry inflation still coming through because I'm sure restaurants raised their costs to try to recoup some of what they had to pay in the additional wages. Right. But then it's a one-off. Do we then see next month that it drops back? That's the guess the Fed has to make.
Let's go to the Fed meeting, and I'm going to start with something I believe I've never seen. We had an ECB rate cut last week, inflation forecasts up by the ECB. I believe I've never seen that. The Fed's not going to do that. When they cut rates, they've got to have an inflation forecast coming down, don't they?
Yes, absolutely. And we get a new forecast from them. They'll put out their summary of economic projections with
the dots,
with the dot plot,
yes.
And they will have new inflation forecasts. Whether they'll change it or not is a question, because these are forecasts of where we're going to be at the end of this year, at the end of next year, and they've already forecast that inflation is going to drop and drop slowly, but it's going to get there. So we may not see a big change in the inflation forecast. It's pretty clear now that we will see a change in the dot plot because everybody, including Citigroup on Friday after the jobs report, priced out their July rate cut. So you don't have 3 rate cuts anymore. You're going to have 2 or 1. That's going to be the issue for the Fed officials submitting their guesses.
Tom Busby would be polite on Bloomberg Daybreak. I'm not going to be polite. Do you have a question yet for the chairman?
Well, the question that presents itself following what we've seen in the last week, and we saw stronger than expected ISM numbers, stronger than expected hiring, is, are you tight enough? Does the Fed have enough restraint on the economy to bring inflation down? And we'll get a partial answer to that from the CPI numbers, but there have been questions about whether the Fed is restrictive enough. And if we're still getting jobs reports like this, one could argue maybe they're not. Their argument has been we just haven't waited long enough.
He is our international economics and policy correspondent, Michael McKee. Thank you so much. And now we dash to big tech, of course, to Apple. Tom Busby, a look at the Worldwide Developers Conference in Cupertino.
On Monday, Apple kicks off its week-long Worldwide Developers Conference event for 2024, but this year is different. It is all about AI. For more on the event and what to expect, we're joined by Mark Gurman, Bloomberg's chief correspondent on global technology. Now, Mark, there may be a lot going on at Apple's Worldwide Developers Conference, but it looks like its AI strategy and a rather unlikely AI partnership will be the big focus. So what do you expect to see?
It's all going to be about artificial intelligence at Apple for the foreseeable future. And at the conference on Monday, they're going to introduce new versions of iOS, macOS, iPadOS with AI at the very forefront. And the big idea is to integrate artificial intelligence in a way that syncs with your day-to-day capabilities in your applications with a strong privacy focus. So you're not going to see whiz-bang features like image generation, things like OpenAI and Google Gemini have shown in their really intricate demos recently. You're going to see things like summarizing incoming notifications, automatically replying to text messages and emails, the ability to quickly edit photos using AI. But there's also going to be an interesting partnership with OpenAI for an integrated chatbot, because Apple knows that some consumers want that functionality as well. So it's going to be a very broad AI strategy here for Apple to set the stage for the next 3 years at the company.
Now, Apple, a little late maybe to the AI boom. Microsoft, Alphabet, even Amazon way ahead. Is this partnership with OpenAI, do you see it as temporary? How soon will Apple have its own AI chatbot?
Apple certainly is very late to the game here regarding generative AI or these modern sets of artificial intelligence based on technology known as a large language model. It's so interesting. Apple was ahead of the game for many years with Siri, which was introduced at the end of 2011. But they got lapped very quickly by Amazon Alexa and Google Assistant. And then they got lapped again with the introduction of OpenAI's ChatGPT in November of 2022. So it's fair to say they were caught absolutely flat-footed. They spent the last year and change trying to reverse that and integrate as much AI as possible through a program known internally as Project Gray Matter. Now, the OpenAI partnership is interesting because this is specifically for a chatbot component and the generation of text messages and different things that you can use ChatGPT for, such as writing email. Now, I anticipate this partnership to be long-term in the sense that it'll exist for the next few years or so. But in the even longer term, maybe 5 to 10 years, you're going to see Apple shift to its own chatbot. But it's going to take a while for Apple to get there. There are still concerns with chatbots and generative AI. There's the idea of what's known as a hallucination, which is AI and generative AI reporting incorrect information to you, taking information from the internet and presenting it in an incorrect way. And that's what Apple's trying to avoid. And by using OpenAI, they're pushing the onus on them rather than taking responsibility for those incorrect information suggestions.
Now, aside from those incorrect information, those hallucinations, is there a danger of outsourcing its AI to OpenAI right now? I mean, that CEO, Sam Altman, controversial figure, ousted from the company for a short time last year. Reasons not quite clear. Are you getting into bed with someone maybe you shouldn't?
I think the only concern with partnering with OpenAI is actually its corporate structure, right? Who owns the company? How's the company operated? Can that board take out their executive team again, like they did at the end of last year, right? Can that company fall flat on its face? Can it fall apart? Does it have the necessary agreements in place to keep that ChatGPT server infrastructure up for the hundreds of millions of Apple customers? So those are my real concerns with the OpenAI partnership, right? I'm not concerned with how controversial Sam Altman has become. I think that you and I care about it. I think a lot of our readers care about it. I think Wall Street cares about it and tech fans care about it. But don't forget, there's over 2 billion Apple devices in use, right? I would venture to say that 99% of people who use an iPhone don't know or care who Sam Altman is. And they certainly don't care about his controversies, his arguments with Scarlett Johansson, or any of those issues. What Apple wants is a product that functions. And OpenAI at this point offers the best technology in terms of a chatbot, in terms of providing generative AI technology. So that's why they went with them. Now, the good news here is that Microsoft is a big backer of OpenAI. And obviously, Apple can trust Microsoft. They've been partners on many different initiatives for a number of years, in addition to rivals. And ChatGPT runs on Azure. So you do have sort of that adult in the room perspective there of Microsoft to make sure this thing remains up and running.
So you have these billions of devices. What changes will the iPhone user or iPad user expect to see, and when will they see them? This new leap in AI with ChatGPT.
So the big changes you're going to see are going to begin rolling out in September, right? That's going to be as part of iOS 18, iPadOS 18, and macOS 15. And you're going to see things like if you missed a bunch of notifications, you'll get a summary of everything you missed. If you record a voice memo, you'll get an instant transcription. If you're using the Notes app to record a meeting, you'll get a summary of what happened in that meeting. If you want to reply to your text message or emails, you'll get suggested full-length replies that are based on what the incoming email or text message was. If you get a bunch of emails coming in, you'll get Gmail AI-like classification, putting your emails in folders for you based on if something's important, work-related, personal, or maybe it's spam, right? You'll get a higher level of email classification. So there's a lot of AI coming in a deeply integrated fashion across all of Apple's apps. It's not only a partnership with OpenAI to power some of this, but it's an in-house, on-device large language model from Apple, as well as an in-house large language model that runs on Apple Cloud servers. So a ton of AI-based functionality coming here. This is AI everywhere for Apple. It's codenamed Project Gray Matter. That's the part of a brain that does a lot of the processing. So this is going to be a very big initiative for the company.
Well, a lot to look forward to at Apple's Worldwide Developers Conference. It kicks off on Monday, and our thanks to Mark Gurman, Bloomberg Chief Correspondent on Global Technology. Coming up on Bloomberg Daybreak Weekend, a look ahead to London Tech Week. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a look ahead to India's inflation and trade data following its fateful elections. First, the tech sector is booming, fueling all-time highs on Wall Street thanks to artificial intelligence giants like NVIDIA. And the rise of AI will be front and center at the upcoming London Tech Week conference, bringing together industry leaders from all over the world. And for more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, as the world contemplates the tech sector's phenomenal growth and transformation, many will be asking questions about the future. Are the gains sustainable? Is the progress ethical? And perhaps more crucially, what comes next? Not everyone is convinced. Recently, economics professor and Nobel laureate Paul Romer told Bloomberg that confidence in artificial intelligence risks repeating the mistakes of the crypto bubble of only 2 years ago. A tech sector bubble popping moment is certainly a fear shared by others in the industry. Some investors are wary that AI in particular has been overhyped, and regulators are fearful of abuse of the technology. Concerns about the future aside, though, tech is also a sector that presents enormous opportunities right now for market players who are willing to take on risk. It's one of the reasons that Apollo Asset Management is so keen to do even more deals in the space after an $11 billion collaboration with Intel. The firm's co-president, Scott Kleinman, told Bloomberg to expect more ventures like it in the future.
I think you're going to see more and more of this coming because absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Right.
Really
I mean,
insatiable.
we saw in the earnings report, right, all these tech giants having an insane amount of capex to try to get their AI capacity up. Intel obviously is one of them. They did, though, say that their manufacturing won't be profitable until 2027. So how much of this also is not just Apollo backing AI, but Apollo backing Intel for the long term?
Absolutely. This is all about partner selection, structuring. Every situation is going to be different. That's the beauty of private capital. It doesn't have to fit one single box. You can really be creative to meet the needs of the project, the needs of the counterparty, and this is just a great example of how you're going to see more and more of this. Yeah.
Well, if you're going to see more of it, I mean, does Intel need more? They're trying to take a crack at NVIDIA. That is no easy feat.
Right. Well, I think Intel's announced over $150 billion of projects. So that's just one of, I think, many companies across lots of different industries that really need this type of capital.
Are you talking to other companies, too, besides Intel for this type of thing?
Well, no comment, but you can probably assume.
Well, just the last thing on this, Scott, because, I mean, we are here in Europe. This is a Europe deal. It's a plant in Ireland, and Europe has been behind on manufacturing. Is there some way that this is almost a test tube, that it's a test trial, and if this works, maybe you do more in Europe like this?
Well, I think just zooming out a little bit, I do think you touch on an important point, which is if you compare the growth rates in Europe versus the growth rates in the U.S., obviously it's undeniable what's happening. A big part of that is companies' access to capital, right? In the U.S., in addition to the banking system, you have a very robust capital markets, a securitization market, a very deep private capital market. In Europe, all of those things either don't exist or are very, very small, very fragmented, very nascent. And I think you need to see more and more of this, and you will start to see private capital play a bigger role here in Europe.
It's a tougher environment, though, because there does feel to be more regulation here. So how does that impact your global allocation, that there's opportunities here, but they're a little bit harder to execute?
Well, it just makes it more complicated, but you're seeing it. I think European leaders are starting to recognize that Europe is choked for capital, that is limiting the amount of growth, that Europe is falling behind, and it needs this type of capital. It needs to encourage private capital. It needs to encourage securitization in order to make that happen. And, I know Europe's been talking about it for a while, but, hopefully this is a bit of the wake-up call it needs to get going.
There's also a rate divergence story happening in the first cut of this cycle from the ECB. Does that make a difference to you at all, that maybe there's easier policy here?
No, I think that's more indicative of the need the economy needs to get boosted by, I'd say, artificial lowering of rates, as opposed to the U.S., where we've been saying for some time the economy is so strong, rate cuts probably don't make sense yet.
Right. Do you think that there are some people in the U.S. then that just have been doing the extend and pretend, that they bought deals at high valuations and have just been hoping for a rate cut? So what happens if we don't get one this year and maybe only a few next year?
Oh, I think that's absolutely right. I think you're going to see a lot of GPs and LPs coming to the recognition that it's going to be a pretty dry spell for the next few years vis-a-vis the old portfolio of private equity companies. It's going to take longer to monetize. The valuation gap between where folks loaded up on deals versus where the market is today is just, there's a big gap, and it's going to be, I think, a little bit tougher for private equity firms to see the type of returns that they were looking for versus years past.
What does that actually look like? What causes that dam to break? And then what does it look like when it does?
Yeah, I don't know that it's so much a dam. I think the reality is private equity loaded up at the top of the market using very inexpensive debt. The valuation environment has fundamentally changed, and as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done. And all that means, it's just math, that returns are going to be lower over the next few years.
Well, I'm sure LPs, investors who hear the idea that they need to hold on for companies longer are not going to be happy with that. They've been clamoring to get their cash back. So how do they do both at the same time?
They generally don't. They generally don't. I think you're going to see sponsors looking for creative ways to return capital, whether that's through structured equity investments or other things into these portfolio companies. But eventually, sponsors are just going to have to accept the valuation environment is lower and start selling companies.
So are you getting ready to buy some deals? Are you getting ready?
Absolutely.
Are you hiring to match that?
No, we have a pretty robust. We have several hundred people already here in Europe, and feel like we have a good footprint. Yeah.
Okay, so you're ready. You're ready for the deals of what they come.
Absolutely.
What kind of valuation discounts do you think we're talking? How hefty could they get?
Well, I don't think it's so much discounts as it is the current environment is just repriced. When deals are purchased at a 0% rate, that implied a valuation environment of X. At a 5% rate, risk-free rate, that valuation environment is lower. And whether marks reflect that or not, TBD, but the reality is it's coming.
That was Apollo Asset Management's co-president Scott Kleinman speaking to Bloomberg's Danny Berger at the Super Return International Conference in Berlin. Well, the future of tech is just one of the many issues that will be discussed at London Tech Week in the next few days. And I've been looking ahead to the conference with Bloomberg's EMEA technology reporter Amy Thompson.
If you look at the lineup so far this year, we're seeing a lot of discussion in the industry about the ethics around how AI is being developed and used, but also how it's already reshaping entire industries. There's keynotes and discussions set up around healthcare and the creative industries, for example. There's also, in a big election year globally, and with our own election in the UK just weeks away, kind of the question of where we stand here on the global stage and what needs to be done to support the tech ecosystem.
Yeah, absolutely. So how important do you think then this event will be for that, to think about that as we are? I mean, we're fully in kind of election mode, election fever.
Yeah, and so the pace of technological development is moving really fast, faster than lawmakers can write regulations or legal cases can make their way through the courts. So we're in this period with things like AI where there's a lot of gray areas, and industry meetings can be a really good place for companies and investors to get together, to come to some, mutual understandings where hard rules don't exist. And, right now we've got Super Return going on in Germany, the big financial show. We had Viva Tech in Paris a couple of weeks ago. The Cannes Advertising Conference is a few weeks from now. Founders Forum is another really interesting UK event coming up this month. So, before everybody breaks for the summer, there's this real push to get together. And it'll be interesting to see how these different discussions inform each other as the year goes on.
Okay, so then, I mean, there's a lot of interest, as you say, but there's also a lot of hype. There is opportunity. Where do you think the balance is between those? Which one is kind of winning out at the moment, do you think, amongst investors? Like hype around AI versus real, tangible opportunity from AI?
We had just come out of this big pullback in investment in the tech industry where we had maybe 5 or 6 years of record-breaking VC investment growth in the UK every year. Then we came out of the COVID-19 lockdowns, and growth in digital services and platforms that we'd seen during the pandemic just weren't holding up. The economy suddenly looked really shaky. Investors hit the brakes, and then came OpenAI and ChatGPT, and it ignited this, absolute fire for AI investment. And all of the infrastructure around it, data centers, chip manufacturing plants, anything with AI in the name, pretty much. You mentioned NVIDIA's market value at the beginning of the segment, hitting $3 trillion this week. Startups are raising tens of millions or hundreds of millions of dollars when they're just a few months old. So it's really tempting to look at this and see potentially the makings of a bubble. But, I guess the two main questions for tech, though, are, will all the investment that we're seeing in AI companies and the backbone to support them, which is enormous, will the demand materialize to support that? And will people be willing to pay for these new services to the extent that you can actually get a return? And are the valuations of the more established tech companies that had big run-ups during the pandemic, are they actually realistic now?
Having said that, what about regulation? I mean, you mentioned the particular focus here in the UK. We obviously had the AI Safety Summit last year. How quickly is regulation keeping up? Talk us through some of the issues that companies in this space are actually facing now.
Yeah, I mean, there's a few big themes there. One, we just saw the DOJ scrutiny around Microsoft's deal with an AI company called Inflection. Regulators have also had a look at Microsoft's relationship with OpenAI, though I think it's probably important to say that the EU rolled out a merger probe recently on that one. But in this sort of race to dominate bleeding edge AI tech, how do you make sure that you're maintaining competition? And you mentioned the AI Safety Summit. There's also the question of laws regulating AI and its uses. A few governments have kind of taken a swing at it. the EU's AI Act from last year is probably considered the standard, but we don't really have a comprehensive global framework in the industry. And everyone's sort of picking their way through how to prevent the worst case scenarios or misuse of the technology while, supporting innovation. And then sort of finally, there's a question of who owns the data. Media companies, for example, are deciding whether or not to strike deals with companies like OpenAI and share their data. But there's also some pretty high profile lawsuits happening.
So that was our EMEA tech reporter, Amy Thompson. My thanks to her for joining me. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, a look ahead to inflation and trade data out of India. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. This week, investors will get the latest inflation and trade data coming out of India, and it comes after that country's national elections. Let's get to Bloomberg Daybreak Asia co-host Brian Curtis for more on what it all means.
Tom, India's inflation has come down to a 4% handle from around 7.5% last year, but it's still too high. Certainly, high levels of inflation were a part of the election story that saw Prime Minister Narendra Modi lose a majority in Parliament. Modi's still Prime Minister and still wields a lot of power, but his mandate has been weakened. We look ahead to India's May inflation report in the coming week and what policymakers can do to help people who are missing out on India's incredible growth story. Modi has just won backing from two key allies in his coalition, allowing him to form a government. Earlier, we asked Tanvi Madan, senior fellow at the Brookings Institution, what's next for Modi?
He will need to think about how to ensure more inclusive growth. The message from voters seems to be that India is shining for some, but not for many. It doesn't mean that you won't see the same direction, but I think there will have to be some tweaks and adaptations. But I don't think this is necessarily a bad thing. It shows that at the end of the day, the ultimate guarantor of Indian democracy are Indian voters, and they want choice, and they exercise choice.
Well, joining us now is Ruchi Bhatia, Bloomberg South Asia economy editor, for more insights on what comes next. So just out of curiosity, Ruchi, how can the Prime Minister provide more inclusive growth?
Well, that's going to be his big challenge as he takes on the next term, because India is a country where we're seeing almost an 8% growth. But this 8% growth is leaving out many. There's wide inequality in the country. Prime Minister Narendra Modi talks about making India a developed economy by 2047, but that is not going to be easy. While India will be on a 6.5 to 7% growth path over the next decade. For it to really punch above its weight or get to a developed country status by 2047, it will have to grow consistently at about an 8% growth level for the next quarter of a century. And that will not be easy. That will need structural reforms, in the farm sector, reforms with respect to land and labor, and it'll need more countries to come into India to set up a manufacturing base. To do all of that, to be able to provide jobs for its vast young population is going to be a tall order. It's a task cut out for Prime Minister Narendra Modi already.
Ruchi, so much to talk about there. I note from Moody's that they said the slim margin of victory might actually delay some of these far-reaching economic reforms. Will people see it that way?
Well, yes and no, because, coalition government comes with its own set of challenges. Remember, in the last 1 decade, Prime Minister Narendra Modi has never had to rely on allies. And relying on allies now would also mean that they would also seek a pound of flesh from him. They would ask for chunkier portfolios. On the other hand, one must not forget that some of the biggest reforms that have happened in India, case in point being the 1991 liberalization privatization reforms happen under a coalition government. So it will be a tightrope walk, certainly for Prime Minister Narendra Modi. While in the last couple of years, we have seen that India has been able to reduce its fiscal deficit, quite a lot from the pandemic highs of 9.2% to about 5.6% in the last fiscal year. Where from here is the big question, and that is something that rating agencies from Moody's to S&P will be watching out. Remember, S&P recently has put India on a path for a ratings upgrade. So one really has to watch out as to how this is going to play out. Having said that, I must also caution our viewers and tell them that India's debt to GDP ratio is a point of concern that various rating agencies and also the multilateral lender IMF keeps talking about. So that's something that India still needs to fix.
So for some of the policies like Hindu First for Prime Minister Modi, I've heard people say that that's not really going to be in question here. But then they've also said Hindu First is fine, but it doesn't put food on the table.
And that's quite visible this time around in the Indian election results as well, because Prime Minister Narendra Modi in the month of January inaugurated the Ram Temple, and quite interestingly, his candidate has lost from that constituency. So yes, the Hindu first policies or the Hindu nationalist policies does not put food on the table. The ground reality is very different. People are concerned about high unemployment. People are concerned about high inflation in the country, which are some of the things that he will have to focus on in his next term. Having said that, given the fact that now he's going to be in a coalition, he will have to walk a very fine line between pushing economic growth and also pushing his Hindu first agenda. Some of the things that he talked about in the BJP manifesto, including a uniform civil code, it doesn't look like that the coalition partners would be okay in pushing such controversial and contentious ideas.
Ruchi, thanks so much for joining us. We do appreciate it and sharing your insights with us. Ruchi Bhatia, Bloomberg South Asia Economy Editor. Next up, we turn to Japan. We get more from Doug Krisner.
Thanks, Brian. The Bank of Japan has a policy meeting in the week ahead, and the most favored view among economists we polled in April was that the BOJ would wait until October before raising rates. However, since that polling, expectations for an earlier move have risen, and that is partly due to continued weakness in the Japanese yen, which threatens to stoke import price growth. Here's Sayuri Shirai, professor of economics at Keio University in Tokyo. She's addressing the yen's level against the dollar.
155, 156 is too cheap, way too cheap compared to Japan's fundamental. So that's why Ministry of Finance intervened in the foreign exchange market at the end of April and the beginning of May. So I think there is some kind of concerted action between the Ministry of Finance and Bank of Japan to prevent the reassurance of further speculation toward 160.
She is Sayuri Shirai, professor of economics at Keio University. So the question becomes whether the BOJ, mindful of that weakness in the Japanese currency, will adjust monetary policy. Joining me now from our bureau in Tokyo is Paul Jackson. He is Bloomberg Economy Editor. Paul, it's always a pleasure. I got to ask you right out of the gate. I mean, she has a point about the weakness in the yen, the degree to which we've already seen intervention. Do you think this is adding a bit of pressure to the BOJ?
I think it most certainly is. We saw Governor Ueda pulled into the Prime Minister's office earlier where he had a chat with Prime Minister Fumio Kishida, and we think it was highly likely that they touched on the yen weakness and Governor Ueda's comments, which clearly were fueling further weakness as he kept underscoring his cautious approach to raising interest rates. So since that meeting with the Prime Minister, Mr. Ueda has been far more cautious in his comments on the yen, and we are expecting them to do something at this meeting in June. However, I think it's more likely that it will come in the form of cutting back on bond buying rather than the actual short-term interest rate.
So we talked about the intervention on the part of the Ministry of Finance, separate from the BOJ. Perhaps they work a little hand in glove, and I think the MOF spent something greater than $60 billion U.S. To intervene in support of the currency.
But what would allowing bond yields to drift higher mean for the yen? Are we to understand it, even that speculation in the market is one reason the yen has come off its lows against the dollar?
We reported that the likelihood of the Bank of Japan cutting back on bond buying at this meeting is a distinct possibility, and I think the yen has responded to that. Just to give you some feel for how much these yields impact the yen, if you go back to last year when there was still like a 0.5% cap on 10-year yields, and since then they've been allowed to move more freely, and at one point reached 1.1%. That movement in the 10-year yield now means that the differential between securities in 10-year securities in Japan and the US has narrowed. I would say that the effect of that is probably about 9 yen's worth in terms of the exchange rate.
Wow.
That means instead of it being around 155 now, if the BOJ was still keeping that ceiling of 0.5% on yields, I think the yen would be close to 164 now.
I think it's important to point out that a weaker currency has helped to import inflation, and that's been a welcome outcome for the Bank of Japan after decades of being in a deflationary trap. And I noticed that for the month of April, in terms of other influences on inflation, wage data was much stronger than expected. Is that solid now? I mean, is it durable, the increase that we have seen in Japanese wages?
That is the big question, because the Bank of Japan has made very clear that if it wants to move forward with the normalization of policy, this is the key thing that must emerge. And what it's talking about is a positive inflation cycle. Yes, good inflation. That's what it's looking for. It's inflation that's driven by rising wages and that drives consumption and drive growth. And this has really been the national objective of Japanese economic policy for more than a decade now. And they seem to be getting closer to it. But the fact of the matter is that real wages are still falling. That means that the wage gains that we've seen, yes, they are bigger, but they're still lagging inflation. And for the average voter, they're still seeing their pay in real terms falling, and they have done for the last 2 years.
Away from monetary policy, I'm curious as to whether or not there are other programs targeted at trying to deal with this pickup in Japanese inflation. Is there anything in the pipeline that's working?
Well, the government for some time now has been offering subsidies on energy prices. At one point, that was as much as 20% of your electricity bill was essentially being paid by the government. I mean, that is a lot of help for the average household. But they are pulling the plug on that. So that kind of help is getting removed. And in place, Prime Minister Kishida has introduced a tax rebate. This is going to be a one-off thing for this year. It's going to be worth about $250 per person. And he's hoping that there'll be a good feel-good vibe factor from that, and that might leave households' purchasing power in positive territory in real terms in the month of June, and that sets him up nicely for a internal leadership party, and then could even lead to an early election after that.
Paul, it's always a pleasure. Thanks for helping us set up the Bank of Japan meeting in the week ahead. That is Bloomberg's Paul Jackson, our economy editor from our bureau in Tokyo. I'm Doug Krisner. You can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug, and thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.